Hello, I would like to welcome all of you to Sintex Plastics Technology Limited Qtr1 con call. It has been a journey for us after separation, after demerging. We had almost a year and we wanted to reduce substantially government business, increase our retail and industrial business in India, and increase our European and American business. So basically to make Sintex more consumer-oriented, more institutional company and have more technology-driven, retail product-driven products rather than concentrating on government orders and government tender business. So this has been a strategic move from us. I think we are almost done now. We have completely curtailed the business which we wanted to, and we are continuously now growing the retail and the institutional business. I would also like to say that you would see a quarter-on-quarter growth. So sequential quarter-on-quarter growth, like Q4 and Q1 is better than the Q4 and Q2 would be better than the Q1. And this year and every year, our quarter-on-quarter growth will make sure that our performance has been benchmarked on revenue as well as on PAT, profit after tax. Our focus has been retail and institutional business in India. What we have done is carved out two separate divisions or headed by two different CEOs. We have the entire team in place. They have been with us since last about a quarter. They are settling down. We will see their performance in next 1 or 2 quarters, and then we will see the launch pad. So we'll see the drastic change coming on our approach on retail business as well as the institutional business. This definitely will be driven to our bottom line, our profit margins to our dealers as well as profit margins to our retailers have been reorganized. Our retail channel has been reorganized. We had a lot of white spaces, new technology we are implementing in retail and frontline manager segment. So entire retail output has been completely redesigned. We have launched it in North and East. We have launched it in North. We had a very good success. We have, since last 1 quarter, we have launched in East. Again, we are seeing a very good traction coming from there. Soon we will launch it pan-India and we'll see the retail focus and retail chain coming into line. We would currently have 2 major product lines in retail segment. One is water tank and second is factory-made doors. As far as institutional business is concerned, we have many product lines. These product lines are technical as well as some product lines are more meant for larger community, but they are sold in institution. And we have completely came out with institutional sales CEO who only concentrates on selling to large corporates as well as large institutions. And these are in private domain. We sell these products, either it is electrical, underground tanks, sandwich panels or certain consumer products, but sold in large quantity to institutes are being marketed through this particular division. We have reorganized the entire division. Pan-India marketing will start soon for institutional business, and we are seeing very good results in first few months of implementing this change. As far as automotive business in India is concerned, is doing extremely well. We do it out of Pune, which is our headquarter for automotive business. Automotive passenger car as well as commercial vehicles and farming vehicles sales are going up, and obviously we would and we are getting benefits out of it. We do want to increase our margins here again, and not only the product sales, and we are working with many different ways and consultant to reduce our cost in plant and operations. We also have a very large focus in S&P. which is our European subsidiary. We have done extremely well. Our margins have been very, very handsome, and we have been in aerospace, electrical, defense, medical imaging, decorative products and solutions. So we are in many, many fields in Europe, and slowly we are getting these products back to India. We also have a JV called BAPL Rototech. We have been doing well, but once we get Euro 6 or Bharat 6 implemented in India, I think this company would start doing extremely well. We are one of the few companies who can do urea tanks in India. I am very positive about our numbers of FY19. I think we are set to touch 3.5 rupees EPS target or above, and this has been our internal target of achieving the numbers, and with the Q1 performance, it looks like we are on course to achieve these numbers. As far as our earnings, strong growth will continue in FY20 also with much lighter balance sheet, with reduced debt, and so our net debt to EBITDA or target of 2.3 to achieve by FY20 is definitely looks achievable as of date. In business models wise, we have been very bullish on custom molding business as well as on our retail, and we would continue to capitalize on the same. Now I would like to thank everyone and take the questions.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Before we take the first question, a reminder to the participants to please limit your question to 2 per participants. You may come back in the question queue if you have a follow-up. We take the first question from the line of Saket Kapoor from Kapoor & Company. Please go ahead.
Good evening, sir. And thank you for hosting the call the next day, as you have promised on the last phone call.
Thank you.
Sir, the most important point which we retail or institutional investors today are facing is the way the stock prices of our group companies, especially Sintex Plastic, is correcting. And sir, what kind of assurance can we get from the management even after posting? In fact, these are not bad set of numbers in any way. Market perception has completely changed and is extremely negative on the company. So what feedback are you getting? Why is this sharp decline in our stock prices, sir?
I think it is very speculative, and as you rightly said, it's a market perception. What they are not seeing. See what we have done in last 1 year, and it is completely not noticed by the investor. We have reduced the debt. We made company cash positive. We reduced the business which was bloating the balance sheet, government business. We reduced our capex. We controlled our capex. Last year we promised 200 crores. We did 166. This year, in first half, we have done only 21 crores of capex. First quarter, we have done only 21 crore of capex for the entire SPTL. So, look, these are all good things which have been continuously not getting noticed by the investors. We are saying we are going to hit 3.5 EPS. Next year, we are set to do more than 6.5 rupee EPS. Cash positive for the first quarter again. This is 5th quarter in a row we are cash positive. Now, what else a company can restructure after being 8 years cash negative? So, this is a huge change. Complete customer change, complete sets of philosophy changed, our management changed, dealers, network, everything has been changed. The amount of work put in last 15 month has been phenomenal by the company. And these are the time we are seeing the results now, Q1. And Q2 will be better, Q3 will be even better than this. So I don't understand why the quality of earning has improved so much. The investors are not noticing it.
So for this year, we are contemplating 3 rupees 50 paisa for FY19.
Yes.
That is what your target is?
I think we are set to achieve the way things are going on right now. The result of first quarter, we are extremely positive to achieve it.
So first quarter, we did an EPS of 60 paise. So and generally the third and fourth quarter are the bigger quarter than the first half. So then the trend...
more or less, now you should see also the quarter-on-quarter sequential growth of EPS because of the things what we have done in last 1 year, the 2 divisions, 2 new CEO, a new CEO in Pune. So total in the Indian manufacturing field, we have 3 new CEOs in last 1 year. The complete change of our distribution, so our branch offices, our regional offices. Again, there is a lot of revamp in the people as well as the officers there, and dealers network and the retailer. So there is a huge change. And we'll see that benefit pouring out in Q2 and Q3.
Right. So does this stock price correction putting a dent on the promoters' holding also, that not lot of holding is getting pledged? You have a big commitment for the preferential allotment to go through by December 18. So can you give us the confirmation that whether the prices stays in 35 or 40 band, we are committed to infuse the capital which we have addressed in terms of warrant at 90 rupees?
Yes, but the time is next year, I think April or May 2019. So that is the time expiry of the warrants. And the current price band, definitely promoter will put in, I think 200 and odd is left. And we are set to put in.
There is no change because 75% is already there in the... already been placed. 25 is pending, I think so, out of the 600 crore.
Yes, but I don't think we'll pledge anymore now.
Okay, so because pledge is also a big issue with investing community, that you are on continuous pledging, so that creates an ownership issue also. Because the more the pledges are there, the company's outlook and the perception also changes, that the promoters are continuously pledging the shares.
No,
that is also giving a bad impression, sir.
I agree, but most of the pledge was for the infusion in the company. So if you see the total money which has been raised is only went into the company.
Correct, sir. But it is loan against loan के ऊपर loan हो जा रहा है. मैंने आप infuse कर रहे हैं, वो भी loan के basis में कर रहे हैं. तो repayment में आपको आगे जाके अगर कोई hurdle create होती है, तो फिर problem बड़ी बन सकती है. मैंने perception ये बन रहा है, sir. यही बोलना चाहता हूँ.
I don't think that will be the issue here. So because we have been careful on raising it in a way that there are no emergencies happen.
हाँ. So the last point is, sir, we have seen in employee benefit expenses moving up, sir.
See, there are a lot of expenses moving up. First, you need to understand the way we are conducting business now. We don't capitalize. So there are hardly any expenses which has been capitalized. We could have capitalized many expenses and showed even higher EPS and paid higher tax. But we wanted to pass everything through P&L rather than capitalizing it. Take an example of new launch on the products. We launched several new products and we are going to launch a few more products now. We changed a lot of finish of our products, so we invested heavily on our molds. And again, those expenses has passed through P&L rather than capitalizing it. We also have a philosophy now to rent a factory rather than invest into land, building and machine. So all those rents also pass through P&L rather than from balance sheet. So we want basically lighter balance sheet. We want to improve ROCE on a long-term basis by deploying less asset to generate profits. And this is the reason why you are seeing employment cost also going up, is because we created for the future two different divisions, PVPC, which is more like a consumer, and I, which is more like a industrial. So two different divisions, two different sets of people, completely focused on future growth, and this will give us benefit and reduce our cost once we start seeing the growth on the revenue. I expect the personal cost and the other cost to go down on percentage to sales basis by Q4 of this year, when we see substantial revenue growth coming because of these steps taken by us. So you have to see this as an investment for the future, and that is exactly what we want to do.
Depreciation.
Mr. Kapoor,
I conclude, ma'am. Yeah, ma'am. I am concluded. Just finance cost and depreciation, what should be the annual figure, sir, we should work with?
1 minute. I think it should remain at a similar level or maybe go little down. Depreciation should go down by about, say, 210 to 20 kind of a level.
Finance cost?
And finance you can average out at about 72, I think. About 280, 285 kind of for the annual thing.
Because you earlier told that we will be saving around 75 crore on terms in the finance cost.
So finance cost, you have to be, you need to understand 2-3 things. This is KKR cost, which we are not paying them, everything. We are accounting everything. So we are passing through P&L the entire cost of KKR borrowing. But cash flow outflow is much lower than this. So that's why you are seeing less reduction in P&L. But when you see our cash flow statement, you will see very, very small amount going as an interest.
Okay, then. They will be receiving it on a cumulative basis. Interest plus principal.
Mr. Kapoor, I'm really sorry to interrupt, but please request you to return to the queue. Thank you very much. Ladies and gentlemen, before we take the next question, a reminder to all the participants again, please limit your question to 2 per participant, as we have people waiting for their turn. Thank you. Next question is from the line of Vijay Lohia from Value Investment. Please go ahead.
Hi, thank you for taking my question. So, coming back to the interest part, so is the entire KKR debt deal now completed? Has the full proceeds been received, and the board representation which was supposed to happen, is that complete?
Yes, the whole thing is complete. We have received all the money, and we have repaid also to our lenders. The board seat also has been allocated, and Mr. Taswinder Singh has been appointed on the board.
Okay, that's helpful. And sir, on the interest cost, coming back to interest, we see that your interest cost at 79 crore was down 10% quarter-on-quarter basis, which is very positive. So given this KKR deal, and you just mentioned that on an accrual basis the cost looks high but cash flow is low. So on an accrual basis itself, what is the interest expense target for the full year that we should see for FY19? And on a cash basis, how much are we planning to pay? If you can just help us with the numbers.
So as I said, about 280 should be the interest for the whole year, and payout should be less by about 60 crores. 60 or 70, I don't have an exact number, but apparently it looks like 60 or 70 crore less payout. So if the interest, if we are booking interest on P&L at about 280, payout should be 40 crore lesser. 40 crore lesser.
So my second question will be on depreciation. So the currency, the INR has depreciated. So how much positive FX impact on revenue growth is the company likely to see for the rest of the year with the currency, Indian rupee, being weak?
So most of our revenue comes from euro, and euro has not depreciated. Rupee has not depreciated that much against euro. So there isn't much change there. There is a 2.4 rupees difference in euro.
Yeah, but average rate has remained the same.
Average rate has not changed much. That is what our CFO is telling us.
So that's pretty helpful. I'll get back in the queue for more questions, and all the best for the rest of the year.
Thank you.
Thank you. We take the next question from the line of Milind Desai from IIFL. Please go ahead.
Yeah, thank you for taking my question. Sir, just wanted to get numbers for overseas custom molding, domestic custom molding, retail growth, and just the YOY growth and QOQ growth, if you could.
I think I strongly urge investors to look us on quarter, at least for this year, rather than comparing last quarter to this quarter, because a lot of things have changed. Our business model has changed, and last quarter, same year to this quarter, 12 months back is, according to me, is not comparable. So it's better to watch Sintex on sequential quarter basis, Q1 over Q2 over Q3, than last to this year.
Yeah, I understand that, but I could still get...
No, sure, we'll give numbers, but when you compare this, I think Q1Q would be give you better strategy where we are going.
Sure, so can you give us a figure for retail? What did the retail sales clock in?
So the domestic custom molding was 460 crores this quarter, and international custom molding was 610 crores. That makes a custom molding of 1070 crores, and the prefab and monolithic is 267 crores.
And what about the retail portion within this, or how you're separated from retail to institution?
We'll separate now.
We don't have the separate numbers now, so and the way in which we are reorganized, we don't have this number now. So
we'll start sharing.
So we'll start sharing as soon as we are done with all the changes internally.
It would be really helpful if we could get the YOY number as well, just so that we can better get a sense of what's happening.
The retail number YOY would be difficult, but on quarter retail numbers we will definitely share from half one.
Fair enough. And as far as the margin guidance is concerned for the year, I can understand. So what would be the target range that we are going for as a company? Because if we adjust the last year's number, we came up at somewhere around 15%.
So consolidated for the first quarter, we are at about 13%. And as I said, we are, sorry? What is it? 15%. And we are looking at a growth in our EBITDA number up to 16.5%. What we are saying is this year we are passing lot of expenses through P&L, which historically and technically I can also book as a capitalized expenses, especially on new product launches and restructuring costs. And these are huge costs, including implementation of softwares, implementation of new branch offices, and training of our frontline managers.
Including auto new programs that we do, technically we can incur those designing costs as a capex rather than opex, but we are doing it as opex right now.
So everything passes through P&L, and that's why it allows us to reduce our capital expenditure in first quarter at 21 crores only. So this is the reason why we are seeing EBITDA margin lower than the last year. But for the whole year, still after adjusting and putting all these expenses to P&L, we think that we should touch a 16% plus.
Fair enough, sir. I'll come back in the queue for the question. Thank you.
Thank you. We take the next question from the line of Vikram Suryavanshi from Phillip Capital. Please go ahead.
Sir, my line got disconnected. So can you just, what would be the current debt level in terms of gross and net debt?
1 minute. debt is 3164.
3164 crore net debt. Okay. And can you help me with the gross debt?
3872
crore. And how is the outlook in terms of prefab looking now in terms of quarterly number, or are we seeing the bottoming out for this quarter, or still 1 or 2 quarter we can see the revenue decline in prefab?
No, see, revenue of the prefab is not, we have guided for about 800-900 crores for the whole year on prefab. And I think we are set to achieve that. We will also see the similar kind of a margin. Every quarter we are looking at about 35 crores, 25 to 35 crores of EBITDA, depends on the project completion. So this is where prefab looks like. For the annual basis, we will touch maybe 90 to 120, 90 to 110 within the range of EBITDA margin on prefab. And I think this is, as I said, this is almost bottomed out. So we are not going to see much reduction here. From the steepest reduction was from like 2,600 crore to achieve at 800 crores, and which this quarter has already seen. So the effect would be very negligible. As the other part of the business will do very strong growth. So I think overall effect will get smaller and smaller. The best year-on-year comparison you will see in Q4. Last Q4 had a low revenue from prefab. And now this in FY19, 20 prefab, 18-19, sorry, Q4 we hit, you will see a huge growth coming year-on-year, quarter comparison.
So we just lost the line for the current participant asking a question. So we move on to take the next question from the line of Sneha Baheti from Credent Advisors. Please go ahead.
Hello, sir. I have a couple of questions. So hello?
Yes.
Yeah. So first of all, last con call you told us that you have launched a new product for automotive vehicles, of which only you are the manufacturers in India, and this product will be used after the BS6 norms come into effect from 2020, right? So yes. Could you give us a little details on this product, and how do you see competition coming in future, and how important is the usage of this product in the automotive vehicles? Can the automotive manufacturers manufacture this product themselves as well instead of sourcing it out from you guys?
This particular product is called AdBlue tank or a blue tank, urea tank. These are the three names. Currently, according to me, now there are two manufacturers who does this. It used in all diesel vehicles. So either it is a generator set, tractors, farming equipment, or passenger automotive, commercial automotive, it will get used. It has to be a diesel engine, sorry. So government was supposed to introduce Euro 6 norms, Bharat 6, in 2018. They postponed to 19. Now they are saying, I think, June 2020. So they keep on postponing introduction of Euro 6. But we are not, but all the manufacturers are taking trials. Volvo, I think, is using on most of their vehicles now. The other large commercial vehicle guys are also started using it. I see this as a very big opportunity. So we can do a lot of business with all the diesel car manufacturers when it is compulsory. My expectation is because it's compulsory from June 2020, they should all start fitting and replenish their stock from September 19. So from September 19, the peak demand should start, and slowly they will push it to the dealers and to the network, so that by June 2020, all the old cars are sold.
Okay. So what customers are you already catering to, or what customers do you already have your arrangements with regarding supplying of this urea tank?
So basically we are taking trials with all of them. All of them are taking trials. Everyone have a different designs. They will always have a multiple supplier. Other than us, there is one more person who makes this tank in India, as well as there are 2 Chinese guys who are importing, and there is one, I think, Korean or Taiwanese manufacturer also is selling, keeping a stock in India and selling. But most of us, all of these guys are very expensive because they need to get it from abroad. So you have to pay duty and transport cost. But everyone is under trial. I think other than Volvo, no one buys a decent number today.
Okay. And my second question is regarding the KKR infusion. So you have said that the money that's going to come will be used for 2 new locations, right? One being Gujarat. So will that be all of the 1,250 crores or a certain percentage of it?
No, none of the KKR money is used for CapEx. All the KKR money has been only for refinancing. So the idea is that we have paid the loan back. There is no CapEx done from KKR money. We are doing 2 locations, but we are renting both the locations. So the CapEx is going to be part of our overall target of CapEx, which we had said 200 crores. But it would be much, much lower than that. So our target is to achieve as low CapEx as possible. Both the new location we are coming out, one Gujarat and one in the south, Hosur. These both locations are going to be rented out premises. So basically building, land, utilities will be rented out, and we'll put machines in it and start our people and our managers and we'll start.
Your earlier rate was, I believe, 10%.
I'm so sorry to interrupt.
Yeah, sorry. I just have this last question.
Okay,
sure.
I'll
just complete it. Yeah, so according to refinancing, your rate was 10% earlier, and because of this refinancing, you're getting an 8.75% rate, right? 8.75.
Yes, that is correct.
So on an absolute basis, you have a gain, but then you had said there will not be any repayment in the next 3.5 years. So then how are you claiming that you have already repaid the loan?
No. What we have done is we have borrowed
50 crores.
90 crores.
1290.
1190.
Sorry, 1211.
1190.
1190 crores has been taken from KKR and 1190 has been paid to banks.
Okay, all right. Okay, thank you, sir.
That includes early payment to the banks.
All right. Okay.
Thank you. We take the next question from the line of Nihal Jam from Edelweiss. Please go ahead.
Hi, sir. Good evening. So my first question is on the infra prefab business. We were just going through the segmental details of the results that you've given. Even if I look at it on a year-on-year basis, and as we've been saying, we want to bring this business down, that despite there being a fall in revenue, our capital employed has not fallen significantly in this business. So if you could just, help me understand that better.
See, it takes time. And that is the whole reason why we want to exit this business. To get money out of it takes hell of a time. So it is to reduce that is going to be a long drawn process. At least it is not increasing. So that is good part. Obviously, see, that is pulling down the entire company's ROC and all other ratios. So the idea is to curtail this, recover all the money which has been blocked and bank guarantees and other things, and then only do prefab business where receivables are at least comes on time.
But in fact, on a yearly basis, if you look at the capital employed, that's actually increased because I think our liabilities in that segment have fallen significantly. So,
excuse me, sir. I'm so sorry to interrupt. Your audio is not very audible. Requesting you to please use the handset mode.
Sure. Am I audible now?
Yes, you are.
Yes, I was asking that if I look at it on a yearly basis, in fact, our capital employed in that segment has actually increased. That's more because our liabilities have fallen significantly while our assets in the segment have reduced marginally. And however, we would expect that when we are trying to bring a business down, our assets would have fallen much more than what the liabilities would have.
See, assets will not fall till the time I don't receive my money back or I don't dispose of the assets. So, either of these has not happened. And that's why you are seeing higher assets. Liability has gone down because of the repayment to the working capital and repayment to the borrowed money.
Okay, sure. And what is the kind of release that we are expecting from this business by the end of the year?
See, what we are seeing is by infusing from promoters as well as free cash flow from the company, we will be able to reduce about 300 to 350 crores on upper limit, about say 400 crores. So anywhere between 3 to 400 crores of debt this year. Our current debt is about 3170 net debt. We want to bring it down to 2800 for the FY19. We are not much relying on the prefab because there the things are quite uncertain. So we have set a target which is more in our control.
So you're saying our debt repayment is more going to be driven by cash flows, and as of now you can't have clarity on how the prefab business will release capital till the end of the year.
It will release the capital, but it cannot be timed on quarter basis. So basically, we can say that it will obviously come down, but there is no precise deadlines given by these people on quarter basis.
Okay, sure, sir. So would it be right, my second question on the custom molding part, would it be right to say that on a yearly basis, the growth in custom molding at say 6% is a little lower than, what we ideally been looking at, say a 12-15% growth considering the high share of retail. So what is the reason for that?
See, mostly it is with the excise duty, one major. Now it is a GST, so we are seeing two wrong numbers. Before that, the entire excise was 27% was part of our revenue, and now it is not. So that is one major change here. Second is obviously restructuring. As I said, we had a lot of restructuring done in last 15 months, especially in last 2 quarters. 3 new CEOs, 2 different divisions, a complete different set of customer approach, new tools implemented up to retailer. So even now retailer and our frontline managers are also being tracked. So everything put together had a lot of disturbance in last 6 months, and that's why we are seeing, but still we are quite happy with the numbers we have achieved without excise duty.
And excluding the excise, what has been the growth like?
20 plus.
20 plus % in the custom molding business, you're saying?
Yes.
Okay, sure. Just one last question from my side. I think at the start of the call you said that
we will achieve far more. I mean, I think next year, 19-20, you are looking at a much healthier growth than this. Huh?
Absolutely, sir. So just one last question from my side. I think at the start of the call you said that you're looking at an EPS of 2.90 rupees, and if I understand that right, that would be, 350, that would be, say, around a PAT of around 170 crores for this year. If I had to just understand that, what is the kind of revenue and EBITDA figure that you are looking at, because you did get a sense of the depreciation and interest that you were expecting for the entire year of FY19.
See, 760 to 810 is kind of a EBITDA we should achieve. And that is what our internal target is. As far as interest and depreciation, our estimates are interest at about 280-85 and depreciation at about 210 to 225. So that is our expectation on these two numbers for the yearly budgeting. And we will see that depreciation going down year on year because new capex has been very strongly controlled.
EBITDA margin expectation?
I said 760 to 810.
Excuse me, sir. Can I please request you to return to the question queue for your follow-up, as we have people waiting for their turn. Thank you.
I'll do that. Thank you.
Our next question is from the line of Devang Patel from Axis Capital. Please go ahead.
Hi, sir. This is Devang from Crest Wealth. My first question was on urea tanks business. Given how many diesel vehicles are sold today in India, what would be the total market opportunity size?
See, market opportunity is huge because on that particular day, say June 2020, every car has to have a urea tank. So every car sold in India has to have a urea tank. So market opportunity is huge. What our capacity, we have two plants to manufacture this, and capacity to do that would be about 350 to 400 crores annual revenue.
How much would the total industry requirement be? Will it meet 50% of the requirement, for example?
No, I don't think so. We will not even touch, with this number, we would touch less than 25%, or touching almost between 20 to 25%.
Okay, so given there will be a deficit in supply, over 4 or 5 years, you think more domestic players will be able to cater to this requirement?
I'm sure there will be. As I said, there are 3 or 4 players. I think they are importing into India and supplying. They are waiting for Indian government to implement Euro 6, and then they may start the production also if they get a large quantity orders from India.
Okay. Sir, on the second question on the prefab revenue, you said 809 crores is what you expect from the segment this year, which is a kind of 50% reduction from last year. And you also want to get out from government business. So, how much further will this revenue fall beyond FY19 over the next 2-3 years?
Which?
Prefab.
I think in the next 3-4 years, it depends on the growth in industrial activity in India as well as the activity on the CSR side, CSR spending, as well as the new infrastructure development drive which central government is doing. Prefab is directly linked with these kind of products. When the large contractors like Shapoorji Pallonji or maybe Simplex or the other large suppliers, they get large contracts from the government, they buy a lot of prefab to support the sites. Large orders also come from the ONGC and oil exploration. Large orders comes from people like tele-infrastructure. So these are the executionable large complex projects require a lot of prefabs. Also on CSR activity, also a lot of prefabs are being used, as well as the facilities which are made by private road builders. So there also around the road, as far as toll plazas, a lot of prefabs are being deployed. So this also depends on the project. But as I said, we think that about 800 crore is something what we should aim for in 19. 20 is unclear, but I don't see major drop coming. I mean, if there is a drop, could be 50-100 crores, but nothing very sharp.
Thank you. Before we take the next question, I would like to remind all participants, please limit your question to one per participant only. You may come back in the question queue if you have a follow-up. Next question is from the line of Keyur Shah, Vigil Investor. Please go ahead.
Hello. Thank you for the opportunity, sir. Sir, my question was regarding our capacity and its utilization. So can you just inform us what is our utilization right now and what would be it for FY19 and 20? And also, because of the businesses which we are exiting, how would our capacity utilization span out over a couple of years?
So, first of all, let me first share that it's very difficult to pin down on one number for capacity utilization because it depends on the machine type, the technology we use, and the product mix that we produce. Having said that, broadly, the capacity is around 65 to 70%, which broadly ranges. Doesn't mean all the machines are loaded to that extent. Some of the machines are loaded more, but on an average, this would be the case. So we still have a headroom, and that's where our confidence in terms of low capex this year. As far as prefab capacity is concerned, prefab capacity, so yes, there is certain capacity utilization which underutilization which happens. But in prefab, a lot of capacity is more to do with the logistics, the way in which we execute the project. And that is more of a variable. So that obviously we don't deploy as we reduce or not take certain projects.
Okay, sir. And can you give some broad way for FY19 and 20? How would it span out?
Sorry? Which year?
Going forward, next couple of years.
So we are very, as just mentioned in the initial commentary also, we are very bullish on the custom molding side, especially the retail and institutional story. The auto story in India is building up. So on overall custom molding side, we are very bullish. We haven't yet taken 19-20 targets, but it should be more than 20% going forward easily. On prefab, it would be more or less flat.
Thank you. We take the next question from the line of Venkat Subramaniam from Organic Capital. Please go ahead.
Hi, sir. Thanks for taking my question. In the initial remarks, there was a mention that we could possibly almost double bottom line next year, while in reply to the questions just now, we talked about just a 20% growth. There is some kind of a dichotomy here. But even otherwise, what gives us confidence for kind of guiding this kind of growth?
No, what we said is EPS will almost double. So this year we are planning 3.2, 3.5, and next year we are saying 6.5 to 7. So that is almost doubling. That is what the comment was. The reason of this confidence in these numbers is the amount of work has gone in last 15 months. We have changed so many things, starting from our sales to manufacturing to the software, the tools, the training, replacing people, replacing CEOs, replacing management, the complete new life we have put into manufacturing process, our quality standards, introduction.
Sir, we have mentioned all this, but quantitatively, we don't see any indication of these numbers coming through so far. We talked about the qualitative.
This is exactly my point is on the Q1, that is what I'm saying, can now see us sequentially. So see us from Q1 to Q2 to Q3 to Q4. And that is also I mentioned in my opening remark that we should not compare us from last year to this quarter, but compare us quarter on quarter because the change is taking effect and we are seeing the results.
But even for this business, which is custom molding growth, we still have a fairly high amount of working capital intensity. You know, we are still sitting on close to about 4,500 crores of net assets on custom molding business for about 4,000 crores of last year's turnover. So for the kind of growth that you're envisaging, again, there's going to be the similar kind of working capital intensity, or the new business model is kind of helping reducing that?
No, definitely. When you see that on growth percentage, our growth on receivables as well as WIP will be very low. The reason is we are also getting here out of government orders, people who pay us late. We are also consumer products, consumer PPC, which is where our working capital cycle is very good. Unfortunately, our raw material is here, which we have to buy on cash. So we don't get much credit on the raw material side. But other than on marketing and collection, we are seeing far more improvement than before.
Thank you. We take the next question from the line of Arvind Joshi from Batalior Advisors. Please go ahead.
Yeah, thanks. My questions have been answered. Thank you.
Thank you. We take the next question from the line of Pawan Kumar from Unifi Capital. Please go ahead.
Sir, my question is on the finance cost. This quarter we had a finance cost of 76 crores. Of course, you told us not to compare on an annual basis. But still, if we look at it, it was 67 crores last year, and this has gone up to 76 crores. We have done restructuring of debt. We have done all the kind of adjustments, but still the interest cost outflow seems to be too high.
So this is not the outflow. This is accrual, and outflow is less by about 15 crores.
Can you just explain the arrangement, sir? Well, I mean, I didn't understand why the cash outflow is less.
Because the interest, average cost of interest on the facility given to us by KKR is about 8.75, and our average outflow year quarter on quarter is 3% less than that, which will be paid at end of 3 years.
Okay. Last year, if I remember, when we started this whole, when we split into two companies, our debt started from being at around 3,600 crores. Currently, our gross debt stands at around 3,800 crores. So we have gone in the reverse direction, if I'm right. Am I right?
No. There is a large reduction of debt. We started with, I think, 3,980 crores, 4,000 almost crores. Today we are 3,180. We have.
You're talking about net debt, sir?
Yes, both are net debt numbers. Both are.
Okay. And one other question is, EPS you have guided for 3.5 rupees and say 6.5 rupees for next year. But is it after the dilution and all the QIP, whatever the extra stock you are going to get, or is it before that number?
As of date, current capital.
Sure, thank you. We take the next question from the line of Anil Jaman from Apex Securities. Please go ahead. Mr. Anil Jaman, your line has been unmuted. Please go ahead with your question. As there is no response, we take the next question from the line of Sanjay Shah from KSA Securities. Please go ahead.
Sir, can you repeat our last year's debt? We suppose the net debt was much less than 4,000 crores because we had a cash lying in our books.
No. What we are saying is our peak debt before splitting was 4,000 crores, and currently it is 3,180.
Yeah, appreciate. But what was the closing debt, sir? Last year closing, March.
Last year closing was 3,628.
So sir, that has gone up in spite of low capex, in spite of unlocking working capital from government.
3,144.
Sorry?
Last year, 3,628 has gone down to 3,144 currently.
Okay. Net debt is, okay. So sir, now
there is a clear reduction and our target is 2,800.
And right, sir, you told that it will be reduced by 300 to 350 crore debt. But sir,
2,800 would be ballpark target, right?
Right. So what we are doing with the cash, sir? Are we going to pay the debt or we are using it for some capex or anything? Because we don't have major capex. We have unlocking working capital from government orders.
Yes, we are waiting certain debt. When you want to prepay, you have to negotiate. So sometimes it takes time to negotiate with the banks to accept the prepayment. Our maturity debt, all close maturity debt has all been paid by KKR. So basically you have to see that we have not paid 800 crores. We have paid 1800 crores of debt in last 15 months or 18 months. So all our early maturity debt has been paid off. Now whatever we are trying to pay back is long maturity debt. And here it takes time to negotiate with the banks to accept without prepayment premium.
Fine. So net debt you target is around 275 crore to 2,800 by this year end. Am I correct, sir?
2800, that is, yes, around there.
Then, sir, we have a lot of cash flow coming in current year. We have low capex in this year, unlocking of working capital from government orders. So, don't you think this is a conservative figure?
Let's achieve numbers. Let's achieve the numbers. Huh? It's good to be conservative.
Sure, thank you. We take the next question from the line of 2P Rex from iThought Financial. Please go ahead.
Sir, could you give us the cash flow from operations number for the quarter and the year ending FY18?
99 crores. 99 crores for Q1. Only from operation, huh?
Okay, sir. And for FY18?
658 crores. 658.
658 and 99 from Q1, right?
Yes.
Thank you. All the best.
Thank you.
Thank you. Next question is from the line of Pinkesh Jain from Way to Wealth. Please go ahead.
Yeah. Sir, just want to know that the promoters fund infusion of 280 or 290 crore in the March is still remaining unutilized. So any reason for that, sir?
As I said, the same thing. We are negotiating with the banks to prepay it.
Mm-hmm. So we will be prepaying.
I expect before September it should happen.
Okay. Sir, continuing on the debt thing, so this 300 crore of promoters' money is still remaining unutilized. I mean, our debt straight away goes to 2,800 crore, and then we are looking at.
We are saying net debt. Please don't confuse with gross and net.
Right, I understood, sir.
This 300 is already deducted in 3150.
Okay. And, sir, I mean, considering this cash balance of 700 to 800 crore that we have currently, the other income of 6 crore, which I believe includes the interest income, is on the lower side. So, I mean, what is the reason, sir?
That will be accounted as and when we get.
Thank you. We take the next question from the line of Sandy Mehta from Value Investment. Please go ahead.
Yes, good afternoon. Could you comment on what you expect? You gave us the cash flow from operations for Q1. What is your estimate for cash flow from operations for this full year, fiscal year 19, and also free cash flow per share, please?
See, on conservative basis, we expect about 550 crores of cash flow this year from operations. And that would account for almost like 8.5 rupee of free cash flow from operations.
Okay, so so is that cash flow from operations 8 to 850 per share, or is that free cash flow after capex?
After capex.
After capex.
All cash flows are after capex. Huh?
Okay. So 8 to 850 in free cash flow is your expectation for this year, and what sort of growth might you see, or what sort of number might you see for next year? Then that would be fiscal year 20 ending.
I expect at least 700 free cash flow from the operations in 20.
Okay. And my second question is, you talked about, and also in your slide presentation, about the retail business that you have, launched, all these new initiatives in the northern states like UP. Can you just give us some more color on what sort of growth rate are you seeing? And you indicated that I think it was the north as well as, so when will you be pan-India in terms of this launch of these new distributorships and new initiatives on the retail side?
So we have a very strong growth in North. We saw at almost 50% rise in retail sales in the North. And obviously we introduce in East and then we'll do South and West. We are doing it for two products mostly currently. I think 90% of our sales is two products in retail, which is water tank and factory-made doors. Once we are completed with all India launch, say by end of this year, 19, we will start introducing new products and again in a similar manner. So basically expanding retail is not only to restrict ourselves for two products or pan-India launch, but we also want to introduce a lot of other products, few products made by us and few products even outsourced.
Thank you. Well, ladies and gentlemen, due to time constraint, that was the last question. I would now like to hand the floor over to Mr. Rohit Dokania for his closing comments.
Yeah, thanks, Janice. Amit sir, do you want to make any closing comments?
As I said, we are on a strong wicket. We have already did the whole backhand work, what we need to do. And we are very positive the way things are panning out. We are excited to go on quarter 2 and quarter 3. As I said, quarter 4 would be the best, and we will continuously perform as per our commitments. Thank you.
Thank you very much.